Hi guys! Welcome to Valeria's Investment School. I'm Miss Valeria. Join me to learn about finances and investments with the help of my mom and dad. Today, we're going to continue reading The Little Book of Value Investing by Christopher H. Browne. I'm going to do a short part in the chapter 5. Buy bucks over 66 cents. After I read, I'm going to show you the most important things of the 5th chapter. And finally, we're going to see 2 real examples applied on stock market. Stay until the end. And remember, if I can do this, you can too. Okay, let's read. Just as some stocks are knocked down in price to sell low relative to their earnings, at times some shares actively sell below their net worth. This could be overreaction to a poor earnings report or industry conditions. But when this happens, these shares become indicates for the shelves in our value investing store. Net worth is simply everything a company owns. Real estate, buildings, equipment inventory, and cash minus what it owns. Subtract what it owns from what it owns. Subtract what it owes from what it owns, and you get what it is. Called book value. The book value per share then is simplify the net worth divided by the number of shares outstanding. When searching for stocks that are a bargain compared with their assets value, we start with those companies selling below book value per share. This was one of Browne's chief investment criteria and has helped me uncover some tremendous bargains over the years. Stocks selling below book value were original, especially from Teddy Browne Bill. Teddy made markets in shares of obscure stocks and frankly sold at deep discounts to their net worth. This led to his relationship with Ben Grahams, as these were exactly the type of Grahams was looking to purchase. Eventually, it was Tom Knapp, that partner who joined the firm in 1958, who led us from bartering to investment management to pointing out that it made a lot more sense to hang on to these undervalued shares instead of just trading them. My first job in the business was to look through the Standard & Poor's and Moody manuals for stocks selling below their book value. Buying stocks below book value can lead to some best investments you can make. For example, in 1994, National Western Life Insurance, a Texas-based life insurance and bond brokerage firm, was selling for a little under half of its asset value. Since then, the shares have appreciated over 600%. In early 1990s, you could buy shares in the brokerage firm Jefferies and Companies well below book value. Jefferies is still a public company. Its book value has compounded handsomely, and it's now sold at a premium to book value. As an added bonus, Jefferies added an electronic trading firm called Investment Technology Group that was spun out to shareholders. It is now a leader in its field and trades at a significant premium to many brokerage firms. Even today, as many investors claim that book value no longer matters. About 1/3 of the stocks I own were purchased because they sold very cheaply compared with their book value. I have done intense research into the potential of stocks selling below book value. In the early 1980s, I examined stocks in the period from 1970 to 1981. I am inside of 7,000 companies that were in Currente database. During that period, I looked for companies sold at no more than 140% of their book value. I sorted them into groups based on price to book value and computed their 6-month and 1, 2, and 3 years per performance. I found that all these groupings beat the overall market over 1, 2, or 3-year periods, although in many instances they lagged for the first 6 months. Buying the lowest grouping stock selling for less than 30% of book value would have turned $1 billion into more than $23 billion. Over the time frame, compared with 1 million growing to just 2.6 million in the overall market. That's all for the reading. Now, the most important things. 1. Network is simplify everything a company owns, minus what it owes, and you get what it called book value. So, the book value per share is that net worth divided by the number of shares outstanding. 2. Buying stocks below book value can lead to some of the best investments you can make. 3. Opening ourselves up to international investments has created more opportunities to buy stocks below book value. 4. To find companies selling below their net cash balances was a favorite technique of Benjamin Browne. As the title of this chapter says, buy $1 for 66 cents. You can buy assets below their book value. For example, the company Volkswagen is currently trading at the price to book ratio of 0.86 times. The price share is $21.48 and the book value per share is $27.91. This means that the company is cheaper in the stocks market, respect to its true value in the accounting book. This strategy allowed Warren Buffett to make one of his best investments. In recent years, when he invested over $5 billion in Bank of America at the price-to-book ratio of 0.22 times, that means he bought shares at around $5. Today, the price shares of Bank of America is around $41. Warren Buffett says a good financial company should be worth being 1 and 3 the price to book ratio if it maintained an ROE of 15%. In these graphics, you can see these graphics right here. You can see the evolution of the price to book ratio and ROE of Bank of America. Constant growth. This is the example of Warren Buffett is called the best investor of all time. In the description of this video, you can find more details about the investments of Warren Buffett on Bank of America and one interesting video with his opinion. Remember, if I can learn this, you can too. So that's the end of our video. I hope you enjoyed it. And remember, if I can do this, you can too. Bye!